Hello. Curious about adding bonds to your investment mix? Bonds are essentially a way to lend money in exchange for interest income, and they can be a stable addition to your investment portfolio. Now, when rates drop, it's like a bonus for those holding investment grade corporate bonds. Why? Because existing bonds with higher interest rates become hot commodities compared to new ones issued at lower rates. If you've got these higher rate bonds when rates fall, their value could climb. That means if you get into a bond before a dip in interest rates, you're setting yourself up for potential gains, making bonds an even smarter play in your financial strategy. When you buy a bond, it comes with a promise to pay back the money on a specific date, and this is known as the maturity date. This repayment is your principal, and this is known as definition of principal. We know when the bond matures, and hence when we will receive our principal back in the event of a default. Mutual funds and most ETFs do not have a maturity date, so there's no set time when you're promised your principal back. Duration tells us how much a bond's price could change with interest rate movements. A higher duration figure means a bond's price is more sensitive to interest rate changes. For example, if interest rates decline by 1%, a bond's price will increase by its duration figure. In more technical terms, bond duration is a measurement of interest rate risk. Total return combines how much the investment grows and the income it produces. We look at how bonds perform when interest rates fall, as this can increase a bond's price and make it a good addition to your portfolio, especially before economic slowdowns when the Federal Reserve often lowers rates to boost the economy. In this example, in the chart below, shows the components of total return for value stocks, growth stocks, and a bond example. Now, value stocks and growth stocks over long periods of time get the same return. They just get them in different economic climates. Value stocks typically provide a dividend as part of the total return, while growth stocks usually have no or a very small dividend and expect their total return to come from growth in the stock price. Now, with the bond, the calculation includes the interest payments as income. And in this case, with a decrease in interest rates, the value of the bond price will increase by roughly 6.92%, or its duration. And the growth portion of the bond's total return for an estimated total return of 11.45%. Now, this chart shows a corporate bond ETF maturing in 2026 as compared to the 10-year US Treasury. This time period is from November of 2018 to September of 2019 and shows the decline, the blue line, in the 10-year Treasury rate and the corresponding rise, the green line, in the corporate bond maturity. This chart demonstrates that bond prices and interest rates have an inverse relationship. And this is what I believe we're on the edge of, with 10-year rates declining. This table is a tool for investors to compare potential returns, price stability, and income from bonds that mature at different times. Looking at the 2030 bond as an example, you can expect to earn 5.59% each year on average if you hold on to the bond until it matures in the year 2030. The price of this bond might change quite a bit with interest rates, since its effective duration is 5.7 years, which means it's more sensitive to rate changes than bonds with a shorter duration or shorter maturity. If interest rates decline, for example, by 1%, the bond price will reflect an increase in the bond price of 5.7% for, in this example, a total return of 11.29%. To maximize the benefit of falling rates, a strategy to invest in longer maturity bonds is key. This sample portfolio shows the return for investing in 4 separate maturity dates, providing a yield to maturity of 5.65%. When you factor in a potential decrease in rates of 1%, the price of the portfolio will increase by 6.58%, for a possible total return over that period of 12.23%. Keep in mind, these bonds do not have to be owned until maturity, but can be sold at any time with a resulting profit or loss. When we look at the top 20 holdings of the sample portfolio and credit quality of the sample portfolio, there are three things to point out. First, notice that the largest bond position is equal to 0.6% of the total portfolio, which demonstrates that this is a very diversified portfolio, which reduces the effects of any adverse company issues and minimizes risks. Two, many of the companies in the portfolio are household names and recognizable. And three, the credit quality of the bonds are primarily above investment grade, and in this case, about 92%. And finally, a definitions page to help with the previous tables. Please let me know if you have any questions, and I look forward to visiting soon. Thank you.